Let's check out the Piercing Line Candlestick Pattern. Hey traders, warm welcome to you. Thank you for joining me. Alright, so candlestick pattern, super useful. There's probably thousands of videos out there on YouTube. I know I've done a good bunch of candlestick patterns, and regardless of what strategy you use, very often it comes down to seeing what's happening with price and using candlesticks to kind of give you that glimpse of what's happening with price. Super useful. The challenge we have as traders is picking the pattern that is the right one for us, and also the challenge is knowing when to use the pattern, because the trouble we have, and I've said this so many times before, and I know many of you agree with me on this, is that we see these patterns, but unless they're in the right position, they're useless. So we'll talk about that in a moment. Anyway, so what is the Piercing Line Candlestick Pattern? Who's it for? So this is a reversal pattern. So if you're trading with the trend, you're looking for a continuation with the trend, this is not really for you. If you're looking for, or if you're a trader, should I say, that likes to find that reversal point, likes to find the sweet spot to maybe take a counter trend trade, to look for the end of a trend, that kind of thing, then this is something for you. So it's for swing traders. You could use it from a day trading perspective to kind of time your trades a little bit, but really each of these bars or candles is one day, because it really only works on those higher time frame stuff. You could use it on a weekly and a monthly as well if you're so inclined, but the point I'm making, guys, is it's not really an intraday kind of strategy. However, if you started to see this building and you're an intraday trader, then you might kind of front run it, so to speak, and assume that it's starting, and then maybe trade from the long side intraday. Okay, so we're going to look at a reversal to the long side. Obviously flip it on its head to the downside. So what do we have? So we have candle one, or bar one, which is a long red candle. So good solid body, opening at highs, closing at lows. Classical trend day stuff, or weekday. We don't want that to be half-hearted. We want that to be kind of, the bears are fully in control. Supply demand very much pressuring into supply. Lots of supply coming on, demand not being able to keep up, pushing price down and down and down. Okay, so next day we get a gap lower. Now it's worth pointing out, guys, obviously if you're trading Forex, you're not going to get the gap, because obviously 24.5, so it's just going to open up at the low. But if we're talking about a stock, or we're talking about an index, the gap is better, because what we want to see is the continuation short term on for the bearish sentiment. So bearish sentiment continuing short term, and that's signified by the gap lower, the move lower. So we get a gap lower, and then we end up ultimately closing at highs, which is above 50% of the range. So 50% of the range, we close above that. And that's the definition of the piercing line. So bullish engulfing would be the full kind of range. So we end up closing up there. And those are super rare, but super powerful as well. The beauty of this is that it's showing us, hey, you know what? For some reason, we've kind of looked down here, and it's almost like the last flush of sellers, because you've taken out the prior day's lows. And obviously if you're using Forex, that would just be a tail as opposed to the open, but you've gapped lower and you've pushed lower, and it's been rejected. All of a sudden, you've now found demand as opposed to supply, and that's caused the rest of the day to be bullish. You've now got a close that's higher than the open, and most importantly, it's broken through the midpoint, if you like, or the 50% range, however you want to categorize it, of the prior day's trade, and it's closing above there as well. So this is showing, hey, we're pretty bullish here. We're looking for a further move higher. Now, some of the things to look out for here, guys. Better after a downtrend. As with all these patterns, if this occurs in the middle of no man's land, it's useless. Forget it. Don't even waste your time on it. Look for something else. However, if you've had multiple days down, very weak, for example, let's say a little bit of a pullback, and then multiple days down like this kind of pattern, and then you see this down here, all of a sudden now we're talking, because you know that you're quite extended, you know that you're quite stretched, and you're waiting for some sign to show that it may well turn. Does it always work? Of course not. An obvious place to put your stop is going to be under that level there if you took it on the close of that day, looking for a 4 or 5 day move back up, or even a full scale reversal, which is very often signify the full scale reversal. So importance is better after a downtrend. If the market's just sitting there doing this, pointless, waste of time, don't even get involved in it. Forex talks about that, there's no gap, you're just going to get the open at the prior close level, because we're just obviously rotating from day to day. A tail minimal. So what do I mean by this? So this shouldn't be too big. However, textbooks say that, but I don't necessarily agree with that. I think that's okay. If that comes down even lower, to me it's an even bigger kind of reversal. The only thing you've got to be careful of is the distance, of course. It can run out of steam. So if the tail's massive and you've gone from here all the way up to here, you know, the bars are going to be running out of puff unless it's some real big thing that's got a catalyst, some kind of news event or something. You've got to be mindful that that's come a long way. You know, bars might need a bit of a breather, whereas if you don't have so much of a tail, just have a little tiny poke lower that reverses, then there might be still much more fuel in the tank for another leg on day 2, day 3. Because don't forget, you know, even if it's a full reversal, it's unlikely, unless there's a catalyst, for bears to just shut off completely. There'll still be some pressure. So once the bulls have kind of rampaged and backed off, there might be some selling that kind of brings stuff down. And what you don't want to be doing is kind of buying here, seeing a day of kind of minor selling and then it going higher. Now you might be able to strike that, that's fine, but the further it goes, you get the point. It might be that you get some kind of a deeper retracement back. So just be mindful of that tail. And the final thing is, it's the close of bar 2 is the important part of it. You know, you don't want to close down here. You want it to close above that midpoint. And then the obvious trade, guys, is that, you know, you take it on the close or you take it on the open of the next day and you look for a continuation. Some of you who want to kind of just grab some profits, take some off the table, your first targets might well be here, depending on where that's closed, obviously, or selling some into that high wouldn't be a bad thing. But ultimately, you know, this is something that possibly you look at and go, this is decent. This could be the start of a serious reversal. And if that's the case, you put your stop in, you leave the thing and you let it run for as long as you think it's going to go, and don't give up your profits by taking things too early. You know, sometimes you're on the end of a trade, you've got to just kind of go, you know what, I've got to risk this thing, and I'm on the end of something good here, leave it, let's see where it goes. One final thing, guys, before we call it a day, if you're day trading this and you start to see the price come back through there and it looks strong, then you might want to position long, like a preemptive strike for it closing above there. Of course, this isn't technically that pattern yet, and it could just kind of rip your face clean off and just go to new lows in the afternoon, as they very often do. We see that with downtrends, guys. You know, we see this lovely little bounce in the morning, everyone piles in going, oh, I've got the low, off we go, and then the afternoon just goes slam through the floor, and it's adding to the pressure, everyone just coming out of the position. So be mindful of that. But if you're aware that you see this kind of pattern, think, well, hey, if I can get a bit of a head start on it, maybe I can work a few bids, get a few positions on. If I start to come up and we close here, you've got a nice head start, because maybe you scatter a little bit more on, or maybe you go, you know what, I've got a nice position. My average entry is actually down here because I'm a sneaky little day trader who's jumped in front of the swing trading crew, and I'll let the swing trading crew jump on that, and it might go 2 or 3 days and I might be able to extend and get a run from that. All right, guys, that is the piercing line candlestick pattern. If you like this kind of stuff, a thumbs up is appreciated. And while you're down there, check out our channel sponsor. Bye-bye.